So in this video, I want to help you understand the value of patience in your trading process. Okay. So have a look at this chart. This is the daily time frame chart of PNB Punjab National Bank. And I'm showing you an old chart as per the SEBI guidelines. This is 31 August 2023. So pretty old chart. But have a look at this base. I want you to pause the video. I want you to pause the video, have a look at this base, and think about what is wrong with this base. Okay, I can see 6 points in the base. So let us draw the base. You can pause the video anytime you want, but I will draw the base here. See, now let us draw the points in the base. So this is point 1, that's point 2, that's point 3, point 4, point 5, and point 6. So point 5 becomes our buy point, correct? So there are more than 10 candles in the base. There is nice tightness on the right side. There are 6 points in the base. But there is one problem. Okay. Remember the moving averages. Remember blue, green, red rule. Correct. The blue line is the 50-day simple moving average. The green line is the 150-day simple moving average. And the red line is the 200-day simple moving average. What is the definition of a stage 2 confirmed uptrending stock? There are two criterias for a confirmed stage 2 uptrending stock: the basic criteria and the preferred criteria. The basic criteria is the blue line should be above the green line and the green line should be above the red line. The slope does not matter, only the blue, green, red matters. Even the price could be below the blue line, that is also fine. Okay. As long as you have blue, green, red, that is a stage 2 confirmed uptrending stock, even though the blue line is sloping down. That's the basic criteria of a stage 2 confirmed uptrending stock. The preferred criteria is the price should be above the blue line, the blue should be above the green line, and the green should be above the red line, and all the three moving averages should be sloping upwards. That's the preferred criteria. But if you look at this base carefully, neither the basic nor the preferred criteria is fulfilled. So even though everything looks nice, even though there is tightness on the right side of the base, I would not buy the stock because it doesn't meet the basic criteria. It doesn't meet the basic things that we are looking for in the chart. What are we looking for? We are looking for price above the blue, green, red, minimum 10 candles in the base, minimum 4 points in the base. If the buy point is in the blue zone, then we want minimum 6 points in the base. If the buy point is in the green zone, we are okay with 4 points in the base. Correct? That's the basic things we are looking for. These are non-negotiables. Okay. Why do we look for blue, green, red? Because if you study the past 100 years of stock market history, it was found that more than 96% of all the leaders in the past were already in a stage 2 confirmed uptrend before they began their big advances. This statement is clearly written in Mark Minervini's book. Okay, I think it is also mentioned in William O'Neill's book. I'm not sure, you can check it. But at least I remember that it is written in Mark Minervini's book. 96% of all leading stocks of the past were already in a confirmed stage 2 uptrend, which means before these stocks went up, you already had the price, the blue, the green, and the red in place. Okay, so we are putting the odds in our favor if we follow that simple rule. And this simple rule is so powerful. Out of 5,000 stocks in India, you can easily reject 4,000 stocks just by using this simple blue, green, red criteria. Okay, keep that in mind. Now, this video is about patience. So obviously, I'm not going to buy the stock at this point. But if the stock begins to go up, there is a very good chance that the green line might go above the red line. Now we have our criteria fulfilled. So let us move forward. I will move the price forward And as the stock begins to go up, there is a good chance that it might form a base because now it has gone into a confirmed stage 2 uptrend. Remember, no stock goes up in a straight line. When it is going up, it will form bases. It will give you an opportunity to enter, and that base has to be a proper base. It should give you blue, green, red, minimum 10 candles and 4 points in the base. That's called as a proper base. If it doesn't give you proper base, we just let it go. Okay. Why to take risk? Okay. Let's move the price forward and see whether we can find another base. So focus on the price now. So I will click here. I will start moving the price. See, the price has started to go up. So obviously, when the price goes up, pay attention to the moving averages. Okay. As I move the price forward, see, now the green line has started to cross the red line. See, now we are in a confirmed stage 2 uptrend because the price is above the blue line, the blue is above the green is above the red. Now look at the latest four candles, four red candles. Now the stock has started to form a base. Correct? I will continue. See, the base is getting formed. Let us wait for that base to properly get formed. Price momentarily dropped below that blue line. There is a falling window here. Now that falling window needs to get closed. See, falling window, countless times I have mentioned falling window on my YouTube channel. I think I am probably one of the very few people in the Indian trading education space who so passionately talks about the falling window. I have mentioned falling window multiple times on my YouTube channel because I think you have a right to know. Okay, the downside gap, the falling window is a very dangerous sign. A confirmed stage 2 uptrending stock is not supposed to create a falling window. It is supposed to create a rising window. And even if at all it creates a falling window, we want that window to be closed. Closed means a close above the upper line of the falling window. So let us wait for a close. So if you look at this, the low of this candle is 79.10 and the close of this candle is 79.15, which means this green candle closes the falling window. It breaks the falling window. Now the stock has gone into bullish territory again, right? Have a look at this. Let's draw this base, okay? Let me move this to here. Okay, let's draw the base. Now, I think in one screen, we can look at both the bases. See, this was the base which we rejected because the blue, green, red was not there. But have a look at this base. Looks very similar to this base, right? But this base is more reliable. This base is more risky because now you have the blue, the green, and the red, and the price is above all the three moving averages, and all the three moving averages are sloping up. Fantastic. So what's the buy point here? So I take this 0.1, 0.2. What happened? Wait. Oh, I chose the wrong tool. So 1, 2, 3. This is 4 and this is 5. So point number 3, this becomes the yellow line. So let me draw a yellow line there. Sorry, what happened here? Wait. Yes, this becomes the buy point. And by the way, do you notice there is one more buy point here? So if we remove this candle, you see there is one, this is 0.1. Let me draw it for you. Okay, this 0.1, 0.2, 0.3, 0.4, 0.5. No, it's not a buy point. Wait. See, I thought there is a point number 5 and 6 getting completed here, but this low is point number 4. So now you understand why there is no proper buy point here. Okay. So I move it one candle forward. Okay. Have a look at this. This candle touches the yellow line on high volume. So obviously you will end up buying the stock here. And there is a good chance that you might reduce your position size on that day. You might not sell all, You might want to reduce your position size on that day because uh, the price has not closed above the yellow line, correct? You get volume confirmation, but you don't get price confirmation. In such cases, what I do is I cut 50% of the position size just to control my risk. What do we want? We want when the stock touches the yellow line on high volume on the lower time frame chart, we want the stock price to continue to go up on high volume. And by the end of the day, we want the volume to close above the blue line and the price to close above the yellow band, or at least the yellow line. So that's price and volume confirmation. So in this case, we did not get the price confirmation, but you wouldn't end up selling all your shares, right? Because on that day, if you notice, the price is still up 1.96%. That's bullish, right? And the previous candle has broken the falling window. These are good bullish signs, correct? So now, if we move it forward, look what happens. There is a rising window. Rising window is a very good sign. Okay. Although you cut your position by half, you still have some shares remaining. If this candle had closed above the yellow line, you probably would not have sold your shares. Now, this rising window reassures you, and that too, it comes on high volume. So, it reassures you that the remaining half, the position that you are holding, that is likely to give you some gains because now you have a rising window. And by the way, when you have a rising window, your mental stop loss, which could be here somewhere, now your mental stop loss is the rising window. If the stock breaks the rising window, right, then there is no point in remaining in the trade, correct? So you see the difference between mental stop loss and that hard stop loss of 8% that I talk about. That is also something that I'm covering in this video, right? So if you notice now from here, the stock takes off, correct? Let's see how far it goes. Let me move it fast. Let's see where it begins to consolidate. Still not consolidating. I think this is where it begins to consolidate. This is the area. So if we notice from here, the yellow line, that's like 63% return. In how much time? From December 2023 to roughly February 2024. So maybe 2-3 months, right? December, January, February, like 2.5 months, 63% return. So the point I'm trying to make here is you don't have to buy here. Okay. You might think that you missed this opportunity. Okay. From here to here, that's a sizable gain again, correct? From this yellow line till here, that's like 30%. You might think that you lost 30%, but there is value in patience. Okay. This was not the correct time to buy the stock from a risk management point of view because the blue, green, red was not in our favor. This was the right, this is the right way to buy the stock. We wait for the stock to come in that proper criteria that we have set out for ourselves. So from 1st of September 2023 till 1st of December, so that's October, November, right? 2 months you had to wait, right? So, sorry, September, September full month, October full month, November full month. You had to wait 3 months to arrive at this yellow line. So that's the value of patience. You are waiting months and months for the stock to arrive at a proper buy point which you can confidently buy. Okay, that is the value of patience I wanted to talk about in this video. Just because you missed this rally doesn't mean that you missed the stock. Okay, and if you are getting like 20-25%, anything upwards of 25%, you're that's good enough, right? How much can you juice out of a particular stock? If a stock gives you like 20-25% return within a few weeks or within a few months, that's a decent return, right? And a properly formed VCP base, the volatility contraction base, it doesn't take much time for the stock to give you 20-25%. You can go back and check my YouTube channels where I bought stock like Moil, I bought K Fintech, I bought Chennai Petroleum, I bought, I think GRSC, it was IRFC. So if you go back and check these stocks, even Keynes Technology, like it doesn't take much time to get that 20-25% return. Sometimes it can happen in 2-3 days. Sometimes it might take 2-3 weeks. Sometimes it might take 2-3 months. But even 3 months, 20-25% return is fantastic. Coming out of a well set base, 20-25% return from a stock is good enough if you have a decent position size in the stock, right? So patience is very important. There are 5,000 stocks in the Indian stock market. Okay, if a stock is not setting up properly, wait, give the stock some time, right? I received an email from one of my students. He said that there is only one red flag on the stock. He was checking Market Smith. He said that there is only one red flag on the stock, and that too it is ASM. Should we consider this stock? I said no. Why would you consider a stock that has a red flag? Let it go. There are 5,000 stocks in the Indian stock market. Why should we look at a stock which is under some surveillance measure, the ASM GSM list? There is no need to take that additional risk. It is not mandatory to put a trade. It is not mandatory to put your money in the stock market. Just because you are watching the market daily does not mean that you have to put the trade. You wait till the opportunity comes, and only then you pull the trigger. Okay, and as I have shown you in this chart, you might have to wait for 2-3 months, but you will get your opportunity, and you don't want to miss that opportunity when it comes, because that opportunity comes on a specific day, and the stock might give you only 5-10 minutes to take a proper entry. And you might also want to reduce your position size after you have bought the stock on the same day, in spite of waiting for 2-3 months, right? So it's hard work. Trading is hard work. It is patience, it is discipline, it is rules and criteria. These are the things that you will have to learn over a period of time if you want to become a professional stock trader. Thank you so much.